So let's just give it a couple more minutes. And in the bottom right of the screen on the Zoom software, you see a window where you can post the question. And that's the reason why I wanted to do the session a little bit more interactive. I understand that you have a lot of questions. We might not cover all of them, of course, in the next like 30, 40 minutes, but if you wish to look into a particular stock or particular asset class, please feel free to pose your question in there. And meanwhile, I would start slow by slow with covering the few things that, in my opinion, are worth noting independently of the asset class that you are exposed to. And of course, for all the people who've seen me in the past, it's not a surprise that I probably would start. With the DXY. DXY, obviously, the dollar strength index is not a surprise for you. I hope you can see my screen, by the way. Might take a couple more minutes until it's projected. So give it a few minutes. Should be on your screen soon. We're gonna see the trading view chart and go into the DXY for now. So first of all, you remember if you've been reading my messages in the last 2 days, it's also not a surprise to you that DXY here is giving us a topping formation, right? That is definitely something we've been expecting for a while, and you might ask yourself, all right, if that is the topping formation for DXY, and so far crypto held quite well, would give a nice tailwind for crypto once we are able to correct here, right? And I think right now, obviously, I might project more levels on the chart, but if you remember, 105.8 or 106 is the level that I want, first of all, to be lost on the XY. That's the level that has been acting before as a resistance multiple times. I'm quite happy that we've been able to swipe all those highs, all these previous highs. And if you're curious about my targets, actually, if we are due for a correction here, that those targets, and this is very, very good for our risk on assets, those targets are way below this 99.8 level. So this is actually giving us a very nice move here. I would say in terms of percentage points, we can expect at least 6 to 8% on the move down within this first leg. And of course, here it's super important to note that it's all very much geopolitically related at this point. And I would suspect that most of you have seen there is definitely a geopolitical escalation that has been happening this morning when it comes to um, Russia-Ukraine conflict, and obviously the fears of NATO being involved into that conflict are percolating as well. And so that, of course, can have some nonlinear effects on DXY, and that also can have some definitely positive effects on the asset class that we're going to cover in a second. And this is the precious metals. Gold and silver are historically behaving and acting the best during the war and during the basically fears related to the war. So that's very horrible for the world, but it's going to be good. And I'm really sorry to say that, because I'm much more concerned, not about what's going to happen with gold and silver from here. I'm definitely much more concerned about what's going to happen with the world. But just to let you know, because many people, I saw that from many friends of mine, they've been rushing to let me know that the war fears are escalating, they need to sell everything and go in cash. Well, this is partially true if you're heavy involved into equities. Yes, equities do correct thanks to the war news. But on the other hand, gold and silver are actually acting normally as a great hedge against anything related to military conflicts and geopolitical risks. Either it's going to come from China and Taiwan, is it going to come from Israel, Iran, it's going to come from Ukraine or Russia, and all of those or any other, I hope not, but if any other situation is going to be escalated in the near future, you would see it straight ahead on the gold and silver chart. You would see, and you already see it, and we'll cover those in a second. But before we are going into gold and silver and other precious metals, because also palladium is something very interesting, I want to bring your attention to this chart, which is by far the most important chart when it comes to the DXY, because Euro USD is contributing to more than 50% of the DXY basket. And so here you start seeing, and I wanted to let you know those yesterday. I wrote it in our Telegram group, but you can start seeing here a very, very, very prominent opportunity for Euro to USD finally giving us a bottom here. And that would mean one thing. DXY is even more probable to correct from here. So, this crazy move that we had in DXY after the elections obviously gave us a very strong headwinds, but we were able to sustain those. And right now, imagine what's going to happen if DXY is going to start correcting 6%. We might have another very strong move into New Year, into the Christmas Santa Claus rally, whatever you call it, and probably even all the way into January, which actually gives us two scenarios from here. And that's why I wanted to have this webinar, because people are asking me in the comments, Russ, do we sell, do we buy, and what's going on? So let's cover those two scenarios for a second, because those two scenarios are quite contradicting. And those two scenarios are really going to be driven by the geopolitical landscape right now. Scenario number one, this is let's say, a linear scenario. This is an adequate scenario as kind of business as normal type of thing. Trump has won. Trump gonna become the next president-elect. And obviously, two things that you need to understand here when it comes to Trump. First thing, Trump won over the discussion regarding the cuts on taxes. There are two ways how the government can basically make their balance sheet add up. The first way, they collect the taxes. The second way, they are able to distribute treasury notes, T-bills, and bonds. And so if Trump is going to cut on taxes, he still needs to finance the budget somehow, even with all the new projects, even with Department of Governmental Efficiency. US still spends tremendous amount of money. So how the Trump administration is going to do that? Through creating more bonds. And what happens in the world of supply and demand, where more bonds are created, well, their prices are going down. So what happens when the prices of bonds are going down? Well, the interest rate that those bonds are providing is going up. And this is the reason why right now we are where we are in terms of dollar, because TLT, and we're going to look at this for a second, which is another very, very important chart. And unfortunately, majority of people in the crypto world don't understand why it is so important, but we know, and I'm sharing those with you. TLT here is actually going to define if we're going to have this nice alt run into the year end or not. And I want TLT to bottom here. I don't want TLT to ever go below 89 ever again. 89, let's mark it on the chart. This is the level for me when I would start be worried about the market health. If TLT, which is right now at 90.8, is start to accept below this point, I would consider there is a danger. There is a danger for the stock market. And I also would consider there is a danger for any risk on asset class, whether it's going to be crypto, whether it's going to be pretty much anything that has a risk component behind, because that would totally incentivize investors that TLT here is never gonna have, or not in the next 3 months, is gonna have this bounce. We are accepting completely beyond the range of anyone's expectation, and this is the time to stay in dollar. This is the time to stay in bonds. This is the time to stay basically outside of equities, right? So this is something we don't want to have. So all I want you to do is to go here, trading view. It can do it on paid version, can do it on the free version. It doesn't matter. You select this 89, you click the right button of the mouse, you click on the small plus button, and you add alert on TLT. And you basically say, I want to be notified as soon as that level is touched. That can happen by your phone. You can have it on trading view. You would know, okay, that's a dangerous point for me. This is the important thing. So TLT here, I see that it tries to give us a button. And why it is trying to give us a button? Well, let's look at something that we've been also observing closely, and it's the United States government bonds 10-year yield. You also start seeing that finally people are starting to anticipate that this intense parabolic move might start falling. This parabola that has been formed, can also expect like this kind of parabola, it is getting more and more exhausted. So there is a point where the yields would start accepting a little bit down, and this is the point why TLT might finally find its bottom. And nothing actually works. Just absolutely. Of course, it's always relative. Investors that want to sit in the bonds, they normally are exposed to multiple geographies, multiple asset classes, and also, of course, they take advantage of carry trades and cross-border capital. So if someone, for example, wants to see, well, if investors are not so attracted anymore to the US 10-year government bonds, then maybe they're attracted by the German ones, for example, to signify, the European, to represent European economy. And so what I like to do normally, I don't like to look at those two charts just in an absolute measure. I actually like to see the delta, how being in the US bonds, which obviously provide more return on investment, is compared to being in German bonds, and how is that disparity has been modified in the last couple of weeks. So let's have a look on this relative chart on bonds. And that will give us a lot of answers, actually, of what we can expect here for other asset classes. And I think the picture here is also quite similar. After this parabolic move that started around the Federal Reserve cutting the rate into right now. Guys, I understand you're thinking here, why do we care about these boring bonds if they bring us 0.5% more, 0.5% less? But we need to understand that bond market here, just in the US, we're talking about dozens of trillion dollars, right? And then you add other economies, you add European economy, you add other developed markets. So, this 40% move in a matter of 2 months, this is very intense. This is very extreme. And obviously, this is what make DXY coming so crazy up in the last few weeks. So coming back to now our DXY chart and coming back to the two scenarios that I mentioned, like maybe let's point it once again. So scenario number one will be a normal realistic scenario of yields coming down, DXY falling, and TLT finding its bottom. Basically saying that disparity or the gap that has been created between the attractiveness of the US economy and attractiveness of European economy is gonna start probably not getting on par. We're still 40%, like after this crazy run, as we just saw in the previous chart, but maybe it's going to be less incentivizing the investors to stay in dollar. So in this case, we're going to have a great time. We're going to have a great time in precious metals. We're going to have a great time in altcoins. We're going to cover the total 3 market cap, total 2 market cap in a second. And we also might have a very good time in all the smaller caps and mid caps. I remember someone in the comments were asking me about Russell 2000, so IWM or RTY, depending on if you're trading ETFs or futures. I also know that some people actually made a very nice gains with SoFi, with Robinhood, with Warner Brothers a bit less. And so those companies were exactly the ones where we wanted to be 3 months ago because we anticipated that rotation from blue chip stocks that done absolutely nothing in the last few months. If you would open the charts of Google or Apple or Amazon, you see it was boring. It was nothing to do. Yes, obviously Tesla moved, but Tesla is more like acting more like a meme stock. And of course, it was widely associated with Elon Musk actually doubling down on supporting Donald Trump and winning over. So yeah, obviously Tesla was the only one that really had this interesting move up in within the Max 7, but much more fun was happening, of course, in equities. And now the set scenario, the scenario number 2, which is non-linear scenario, which has nothing to do with disparity between bonds and currencies and whatnot. This is pretty just sad war mongering scenario. If neoconservatives or the people with more hawkish stance on American foreign policy are actually gonna win over through those conflict escalations, and there will be a certain retaliation from the Russian side, and so which is very unfortunate. But if we enter that scenario, that this gonna signify nonlinear events in which gold and thus silver and dollar can both go parallelly up simply because people are selling their assets and they're putting them into those two classes. So European investors going to go into dollars, Australian investors, Canadian investors going to go into dollars. And that means that dollar can have this actually prolonged rally. For those thinking, okay, how far it can go? Well, you know, those things like RSI, overbought, oversold, it only works in a traditional situations when we are having, unfortunately, like this kind of escalations around the war three potentiality. Things can go ugly and they can go very far. But again, we cannot predict non-linear things. We can only act as if the other investors also acting rationally, because beyond that, everything becomes a little bit of a speculation. And so we should, in my opinion, we should prioritize the probabilities around the events which are actually predictable and more driven by the conscientious forces all around the world. And here, as I've been saying, I thought vis-a-vis major currencies such as Canadian dollar, I also feel that US dollar, and I wrote it to you yesterday, guys, where we were just around here at 140, 140.6. I think US dollar is at a very, very, very attractive point to be converted to currencies. I would suspect we don't have Forex currency traders here among us, but I also understand that we are acting across different geographies. So for example, most of our junior miners on silver would be located and traded in Toronto Stock Exchange. So they're denominated in CAD or Canadian dollar. So if, for example, you have your saving account or your IRS account, a Roth IRS account, and it's in US dollars, fine. You can, of course, already before even buying those stocks, you can convert some of your dollars, or maybe you got a new paycheck. Maybe you got paid by the end of this month, or you're expecting to be paid by the end of this month. It's not a worst idea to convert part of your USD dollars into Canadian dollars, for example, if you are expecting to allocate in the next 2 or 3 months more money into those miners. I think I spoke enough about these various macro regimes. I would actually now like to go and look on the precious metals themselves, because here what I said is actually quite important. People are asking me, and I understand where these questions are coming from. People are asking me, Russ, should I buy more, or what are we waiting for then? Everything is bouncing, and I'm like, yes, this is true, but in a normal way, in a normal, adequate, linear scenario, scenario number one, which is just driven by macroeconomical forces, cycles, quadratic waves, just typical things beyond the force majeure, I would expect that we have our 5 waves up. We had our 5 waves up. And now we're going to have our ABC correction on the way down. So I think that is very, very likely for gold to retest this 200-day moving average. And right now, once again, I don't like moving averages too much, especially on crypto, but commodity market is a very old school market. There's a lot of people there above 60. They're actually really still trading based on moving averages. So it actually works the best in the commodity market. If you ever have to use moving averages somewhere, that's actually the market where it works quite well. So you would see here that this 50-day moving average, exponential moving average, is right now starting to act like a resistance. And this is why in a normal scenario, in scenario number one, where everything just goes business as usual and macroeconomy does its job, we're gonna have this ABC correction. So that means that if you are not an intra-month trader or intra-week trader, which likes to catch every move of 2%, then you should not contra trade the trend. This trend is clearly down here unless we accept above this 50-day moving average. So please, if you are in precious metals, if you want to increase your allocation, there's no need to rush into those full on. Of course, you can start DCAing because, and we will see that in a second, because beyond the precious metal charts, we also have the miners charts, and miners normally are more beaten during those kind of downtrends, and then they are more volatile and more upward looking during the uptrend. So of course, the miners might not get that much down, even if gold or silver continued down, because they already had heavy beating, and we will see in a second how far. So that's the game plan. That's the game plan for gold. So now let's speak of timelines, right? I would expect everything would depend if you're able to break through that zone or not, because it can also happen if you take the scenario number two, if the retaliations is harsher that we are expecting, if despite Donald Trump's commitment to step in the history as a peacemaker and so on and so forth, if the current effort of Biden to actually bring more escalation are met, then it can be ugly. And in this case, what does it mean ugly for the gold? It means gold gonna go much more up. And so that can become also our ICL, or intermediate cycle low. In a commodity markets, you have so-called ICLs and DCLs. The DCL is like a smaller form of ICL. This is a daily cycle low. So in the case of scenario one, we're gonna have a DCL here, bounce, and then our ICL at the wave C around 2,480, 2,500. In the scenario two, we just had our ICL 2 days ago, where we were adding more palladium and so. Now, looking at gold to silver ratio, the good thing. That's a good thing here to be in silver, because gold to silver ratio provides us fundamentally much better opportunity for the upside. Why? Because gold to silver, it's still hanging out around 80 plus, 85 plus, sometimes 90 to 1. And you guys remember from our fundamental video that there is that 16 to 1 is an amount of gold produced versus silver. So the disparity here is huge. And that's the reason why we are much more allocated into silver, because indeed silver gonna come later, silver gonna run later, but gold to silver ratio can give us a nice attractive number of 48 or 50, while we are right now at 84. And guys, also the first move, very often in this commodity markets, the first move is the false move. So it can also spike somewhere here to 88 as it did before, and only then go down. Why? Well, because fears of war are always helping more conservative asset classes. And of course, gold that does not have much of industrial application is going to benefit much more from the war fears and war escalation than silver, which brings us to that kind of picture for silver. Let's open it and let's look at the silver chart before we go into miners. I think it is very important that we also don't lose the big picture here. And the big picture, guys, the big picture is not on my chart right now. To go and see the big picture, I need to go the weekly or monthly. We are right now breaking out from the 13 years long cup and handle formation. That's why I always want to start with the big picture, because I don't want you to get kicked out for 50 cents move or $1 move out of immense cup and handle accumulation here in the silver market, because it is quite inevitable, in my opinion, that we're going to be 1 year from now, 14 months from now, we're going to be talking about silver in the higher 40s. So this is super important to keep in mind. Don't get shaken out for 50 cents move, or even if it's $2 move, it can be horrible. It can be horrible for a lot of junior miners, because some of them would correct 10, maybe 15% because the liquidity is low, right? But guys, this is the cup and handle formation here that I might open another silver chart because this silver chart doesn't have enough of historical data. So let me try to see the one from capital.com or the one maybe from CVC. Yes, that chart is much better because it's much easier for us to see this cup and handle formation here. Let me make the screen a little bit less heavy so it's easier for you to see. So we are basically breaking back to the levels where we were prior to 2013. The cup, let's draw it. The cup formation and the handle. And then we had even smaller handle, right? So that happens also very often if you actually study that pattern, because of course, everyone knows cup and handle formation. So people start getting very long here. You remember what was the sentiment around silver in June? I remember that even the crypto Twitter, even crypto Kaleo and all of those guys were like longing silver here. I was like, bro, you don't know how to trade. Go study those patterns. It's so funny. Actually, guy posted yesterday the message on his Twitter saying that he lost $500,000 on his account over the last 1 week where everyone was bullish, and he's stepping away from derivative trading. And yeah, it always felt for me that's ingenuine. But unfortunately, that's the case for many influencers. Just because they have a lot of followers, people think that can be respected, but very rarely that's unfortunately the case. In any way, not speaking of crypto Kaleo, I just saw how sentiment was crazy bullish here on silver, and this is normal that we're gonna have this little tiny handle again. Why? Just to cleanse all the longs here, right? And we also know, because we observe COT data, we know how crazily short went the banks, the smart money. And for them, this 15% drop is a huge drop, guys, in the commodity class of more than $1 trillion. They engineered that drop to get out of their shorts because they didn't want to close their shorts at 32. They wanted to create some WAN that would allow them to cover a tiny bit cheaper, tiny bit, let's say with tinier, less of losses. But if you remember, we spoke there about several $100 billion of unrealized losses that the banks were sitting at, the biggest losses in the history of precious metal. And what happens when someone closing their shorts at the level of 26? Well, they have to open an opposite type of trade. So they're covering their short. As I explained to you, they're opening their long. And what happened immediately with the price? Obviously, price bounced. You remember that amazing bounce? We all made a lot of money from 27 to 34. 26, 27%. Everyone gets really bullish again. People again start speaking. Crypto Twitter people that never touched anything fundamentally, they start speaking about silver again. So it's okay. You now need to clean a little bit those leveraged apes. So don't get too much discouraged. It's a normal move. But once again, there are two options here. The first option, we buttoned, and we're gonna go now in our next wave. The second option, if that ABC correction together with gold, then we need one more down. And where I would see this down can bring us, I think that this down can bring us to this pocket of liquidity around 28. So let's mark this 28. Let's put also an alert here, because if silver goes to 28, I cannot promise this to you guys. It's very much driven by many factors. But if silver goes to 28 here, I'm going to go on margin and I'm going to add a lot. Both I'm going to add SIL, which is going to be my conservative way to be exposed to silver miners, not the junior miners, but a silver bigger miners. I would say that SIL might be a great trade here. And of course, I would add a lot of precious metals that are correlated to silver. For example, Palladium. Let's speak of Palladium for a second and see actually how lucky we are to be here, what it gives us, those prices below $1,000 per troy ounce. Oh, while I was saying that we're already above 1,000, I saw that we had a very good day today in Palladium. But then in any case, anything around $1,000, we are on a weekly chart, by the way, right? So this, we are still very, very early. We're still very, very early. We are just trying to break through that resistance, that diagonal resistance that been forming there. And now we had our first market structure break. We created higher high. We created higher highs on the weekly in that zone. And what happens right now? Well, we are testing our demand, if the demand gonna hold or not. So this is our demand. Normally, it is signalized by this very intense high volume node, a high volume candle. You see this dark green hammer candle on the weekly. So we just tapping back into our demand. And what I see already, not just the demand held, but there was so many beats that we couldn't really even like come and test the demand even for a week. We got immediately this very strong Marubozu candle, this type of candle that has no wicks at all. It started at this level, and right now you see how strongly Palladium is acting on the weekly. It is creating Marubozu engulfing candle, and I think from now, whatever gold is going to do here, I think it's already good to be allocated on these levels. So there are two ways to get allocated. I prefer at this level, I just don't think that there is much more room to go down. I prefer PHPD or PAL as an ETF, but you also want to use the same strategy as we use in silver. So you also might want to be in one of those two producers. Either we speak of PGM. So when we speak of, well, let's actually start first with SBSW. I think we are much more exposed to this miner. It also has production facilities across multiple countries. I think they are operational in almost 60 countries around the world. It's a multi-billion-dollar company, so the risk here is also much smaller. The potential returns might be smaller too. But once again, I think here it is giving us a very interesting market structure. Many people are asking me, how do I look like at this chart? Remember when we were losing that range, I said, guys, for me, this is a clear point of three structure. This has been PO3. Most of you already know it. Accumulation, that range, as Kathy Wood likes to say, well, she's a bad trader, but she's still a smart woman. She likes to say the longer is accumulation, the more extensive is going to be breakout. And then we have this manipulation to make sure to trigger all the stop losses here. And now I think, in my opinion, we're entering this expansion phase. And what supports my idea is that from here onwards, we're starting to create a very bullish market structure where obviously we are creating higher high and higher low, higher high. And now this low has been supported. This low has been defended. So what you can do as a trader, you might want to start scaling into SBSW, again, with two options here. Either you enter here, as I said yesterday, at 4.2, 4.16, 4.22, couple cents more, couple cents less, and then your long position is going to look somehow like that. You don't want the market structure to be broken, and you let it ride. Let's see how far we can let it ride. I think, um, comparing to our, like, even guys, even September, October prices, when Palladium was just a couple $100 more, you understand how miners are functioning. The EBITDA is increasing so much that we definitely can target is $7. I would even say my target for SBSW, my first target is $8. So that gives us a nice trade. This nice trade is very nice trade because it's 9 to 1. Yeah, maybe 8.5 to 1 or maybe 9.22. That's what I see on the screen. But once again, anything significantly above 5 to 1 is amazing trade. So it gives us basically 9 times the right to hit our stop loss until the trade actually is playing out the way it is expected. Of course, I don't want us to have our stop losses hit too much too often, but that's why I am already in the position, and I consider that is a good trade. Or you can actually extend your stop loss a little bit higher here, and you would say, yeah, maybe we're gonna come and take this gap in the worst case scenario if we're gonna go for the option number one, and gold is really gonna go down to 2,500. So you can also do that, and in this case, your risk to reward ratio is still stays around 4.5 or 5 to 1, and then it's actually gonna be improved because instead of closing it here, you can add up a little bit at a $4 level. So in my opinion, this is also an amazing trade that you can play, and you can play it alongside with physical Palladium just to be more on the safe side. And just again, once again, please check why Palladium is used as the industrial metal. What are 12 or 15 ways how we use it right now and in a production in many other industries. So this is actually a demanded metal, right? It's not purely driven by speculation. It's not purely driven by fear of inflation. It is not just a safe haven asset. This is not something like gold or Bitcoin. Actually, the world, humanity demands a particular number of tons of palladium year by year just to maintain certain operations, from photography to photovoltaic panels and whatnot. So once again, this is like an industrially used metal. So for me, it is much less of a risk than, for example, trading gold, right? Because once again, gold is acting very good in the regimes where we are right now, with the monitoring M2 is increasing, but it also has been 10 years where the gold bucks like Peter Schiff have been having no returns at all, right? So it's also not something that you want to be allocated for. That's the reason why, for example, Warren Buffett, he only gonna own the stocks of the underlying miners. That's why he is heavily into barric gold, but he would never own the gold itself because he feels he's wasting his capital efficiency just sitting in some asset class that could make a move once in 10 years if there is a certain fears, right? So now comparing to the metal, which is industrially used, and comparing to that, you also have a miner, which is on top of that going to be benefiting from this gold move, right? So that's what I wanted to tell you from the PGM perspective, or precious metal. So Oh, sorry. I wanted to say platinum group metals, which includes platinum and palladium. Platinum is slightly less attractive to me here, so we're not gonna spend another 10 minutes just speaking of platinum. But if you want to be allocated to both platinum and palladium, there is the ETF, which is a physical ETF run by Eric Sprott. So basically, those guys are really purchasing and storing in their storages and warehouses that underlying amount of a precious metal for which the ETF is provided. So if you want to slightly diversify and not just be purely in Palladium, then I recommend you entering the sticker here above SPPP that gives you exposure to both platinum and Palladium. And the great thing about those, this is not buying like a paper derivative contract where infinite number of shorts or longs can be created out of thin air. This is pretty much serious because in order to create an extra share within that ETF, you need to deposit an extra troy ounce of an underlying metal. So it's always going to be driven by the healthy supply demand ratios around the world and not just purely by the derivatives speculations. I think it has been a nice way to cover PGMs. Two quick asset classes I want to bring your attention into. There's all this interruption around me not being able to communicate to you for a while. Like we started covering lithium. I spoke about those few times. Of course, we all know about Piedmont Lithium and about Albemarle, ALB, which is part actually of S&P 500. So it's a quite a secure and safe company. But we didn't speak so much about global lithium battery ETF. And here, I think we also start to build a very nice momentum, because you can see also how heavily this ETF has been beaten from where? Well, from golden era of cheap and free money. From 2020, 2021, 22, you remember Chamath Palihapitiya ran a bunch of SPACs. Everyone was speaking about future of mobility. Everyone was running the new Tesla killer. Obviously, all the things pumped this asset class tremendously beyond any reasonable numbers. And this is why we are actually, you know, how many percents we are down from the top of 2021? Well, we are 65% down, guys. It's also, this is why I'm saying this is not like a liquid altcoin. This is one of the most used rare metal. I forgot how they called in English, terrar in French. It's basically, we have cobalt, we have lithium. And so those are once again, industrially used metals. And I would not expect here that we're going to go like 95% down from the highs. Why? Because this is not Peloton. This is not some liquid altcoins, some layer 4 on Solana. This is actually, once again, industrially used metal. So 65% discount is good. Don't be too greedy. Don't expect that it should be 71. 65 is good. So let's put our attention on lithium here. And two options, once again, we can either get allocated to lithium directly, or we can get exposed, we can either get allocated to lithium through an ETF, or we can get our exposure directly through one of the producers. And in this case, you know that I like PLL. I like PLL despite a tiny bit of geopolitical risk. Unfortunately, they are more involved in Africa than I would like it to be, let's say, to consider safe. But in my opinion, still, we are holding this 50-day moving average quite well. We are creating, again, this PO3 concept. That's why I wanted to illustrate several times to you how PO3 can work. Accumulation, manipulation, distribution, just covering, taking the liquidity from those highs at around 30 can still provide us an amazing opportunity for 100 plus percentage points move. Why also you understand right now, with the future of mobility, with Trump winning over, with Elon Musk receiving a bunch of governmental donations and so on, lithium gonna start being hot again. There was period of time where it was like, where Democrats were in power, where everyone spoke about ESG and how harmful it is for the world. So both things are true. I'm not saying that someone is right and someone is wrong, but you know how you see things always through the different prism? I think right now the world is again shifting towards seeing the good things in EVs, thinking that Tesla is doing a good job and actually percolating the demand for that metal. Albemarle is a much better point here. I think fundamentally speaking, that stock would be traded at around 150 in a matter of a year. So once again, if you are willing to wait for a year, if you're a little bit stressed that it's done nothing, in my opinion, stock looks really good and will actually look even better once we're able to accept into this previous range. Because that's the point, and that's why I'm teaching you, in a world of trading, don't buy it right now. You see how hard is it. This is the zone of resistance. There used to be the previous support that we lost. I remember this quite well. This is the beginning of this year. And right now we have both 200-day moving average and this resistance. So give it a few more days. And that's why I'm saying you don't have the goal in mind to buy it as cheap as possible, because then we will be trying to catch a bottom and buying it at $73 or something. I actually got quite a big exposure, but I was getting allocation through cash secured puts. So I had less risk. And most of you already know how you can run the cash secured put strategy. The only problem is that stock, that each cash secured put is responsible for 100 shares. So to sell one CSP, you would get assigned 100 shares of Albemarle, whatever the strike you choose, and that's already $10,000 per share. So it depends, of course, of if it's a comfortable assignment for you. You know, for someone trading this $100,000 account, they might say, okay, fine, I want to have 10% of this lithium stock. But if you're only trading, for example, this $40,000 account, you don't want to have $10,000 in one particular stock in one asset class that is, not even the preferred one. If it would be a silver miner, probably would say fine. But so cash secured puts, unfortunately, working better when you have a larger accounts or when you have cheaper stocks. So be mindful about that. But coming back to this point, 108.5 is the zone that I want to be reclaimed. And only when this zone is reclaimed, I want to be fully assigned into my position in Albemarle. And there is a very, very quick 20%. You see how Albemarle is trading. Very often this 20% could come in as much as 2 weeks of trading, right? So that's not bad. That's not bad for 2 weeks of trading. I know that the stock can be quite volatile, but once again, the good thing about it, it is part of S&P 500. It is not some illiquid miner. Not saying that the liquid miners are bad. Sometimes they are the most undervalued ones. And there's where the guys like Monish Pabrai would actually really make a big gains, becoming billionaires onto buying actually very, very suppressed ones. However, if you're more of a conservative investor, you are happy with just going up into this range is 20%. But once again, don't forget where Albemarle was 2 years ago. Just to come back to where we were 2 years ago, we are speaking here about, well, I don't even have the screen for that. Need to zoom out a bit. But jokes apart, yeah, it's another 200% runner, which I'm not saying we're going to get there. It all really depends on lithium supply and demand. And the last one for today, you see, guys, I have so much to share, so hard for me. I was observing so many asset classes. But the one that I never mentioned yet, neither in the past, Data Dash, nor in my current Telegram group, this is the copper, and this is the copper miner ETF. And guys, there is a huge correlation between copper prices and silver prices. We're not going to cover it right now. Why? But copper is providing us a very attractive point. You see my previous trade here. Unfortunately, I get stopped out, and I am very happy to re-enter this trade. I think here scaling in around the level of 40 to 41 can give us a great move in copper miners. Once again, you don't need to pick up the miner. You don't need to risk any kind of bad managerial decision. You're just getting exposed to the ETF that tracks the performance of producers of an asset class, which you find lucrative. And copper itself, I don't know if anyone has done the research or so. Copper itself is in a very good point here because we are still holding. And once again, today I'm doing a lot of diagonal lines, which is not my style at all when we are doing some more volatile assets. But again, here it's an old school thing for old school people. So diagonal lines are working more often than not. So we still holding the support. You're buying at a very nice point. You're buying with all the respect to market structure, higher low, higher low, higher low, start printing higher high. So what will be my next expectation is something like that. So that can be amazing trade once again. You can treat it in two ways possible. What I normally know is those diagonal lines need to be also broken. Why? Because that's too many of not sophisticated traders would respect those lines, so they need to be cleansed. Maybe we're gonna make this quick cleans out. So don't get shaken out. Don't get shaken out because this is exactly what the market maker expects you to do. They expect you to start believing that we lost this line, so it's gonna go lights out, down, dead. But this is exactly where you accumulate for the next move. And once again, I'm not recommending you to get exposed to copper itself. I'm recommending you to get exposed to copper producers. With that said, guys, I'm now gonna go quickly through the questions and let me let me look at what you were guys asking, and I'll try to cover it very quickly. So I had a question about Leo Centrus Energy. Let me quickly look at the chart. Guys, as I said, I don't know, there's some people joined later, so don't worry if you were not here from the beginning. I asked my technical team to make the recording of this video, so that's all going to be on YouTube. Guys, speaking of Leo, I think Leo is giving us, give me a second. I'm going to project the screen again. I see. Good question from Liron about miners and escalation themselves. Then copper ETF is COPX. So if you can't trade Axel, if you can't trade something in Germany, you sell you sell one put and you get assigned. And in this case, it's also going to work for Germany, for France, for the UK. I know it's very, very, very annoying sometimes to be in Europe because this way you are not able to basically buy the ETF you want because KID is not available or wherever the compliance reason is. So you just get assigned for one contract. And in case of COPX, it's not an expensive ETF, so it's good. You just take the expiration closer, and then you try to select the strike price also closer to yours. So you basically get assigned slightly below to where the price is right now. So even saving maybe half a dollar and you get a better price than everyone else. But this way, the broker is obliged to satisfy your assignment. Do you see any risk in trading US tickers for civil miners, lower volume, or is the main benefit the currency conversion? Well, the reason I am trading it directly on Toronto Stock Exchange because of two reasons. First of all, I want to take advantage of, in my opinion, this disparity over extended Canadian dollar versus American dollar. The second reason is that I think that the higher volume and normally the the nature of those moves is more natural, you know, the nature is more natural. Sorry for my tautology. I just wanted to say the patterns and how the stocks are trading are slightly more comfortable for me. Once again, there is no big difference. If you feel better, if you feel that American ticker is easier for you because you avoid the double conversions or things like that, there is absolutely no problem. Then I might, I might need to check if those prices actually packed on the closure of the day level, because that can be the case. You know, a market maker would need to actually rebalance the position. It does not have to happen intraday. I understand it's very simple. If you just place, you know, directly market order for $100,000, you would move the price of any of those miners. So obviously market maker cannot do much, but over the day they are rebalancing the prices. So yes, unless you're an intraday scalper, you don't have any difference there. Great, thank you for organizing the webinar, Ross. Thank you, Heroin. So you indicated preferred PM allocations. How much would PM ideally be of your total portfolio? Very, very, very good question, guys. I think you remember from my last not the last, actually, it was somewhere end of October, still on YouTube. I was mentioning to you that we have four types of regimes. We have growth up and inflation up. We have growth up and inflation down. We have growth, adjusted growth down, inflation up, and we have growth down, inflation down. So we just, in my opinion, we shifted the macro regime. It doesn't happen overnight, but it happened in the last 3 months, in my opinion. And in this case, but inflation is actually not yet combated. It shows somehow good numbers, but I think with Fed cutting and inflation are going higher, above 3%. I would think we would have above 3% prints next year for sure. In my opinion, I would like to focus here on commodities. I might have some equities play here and there, but it should not be more than 15, maximum 20% of your portfolio. Now, I'm a trader guy, I'm a macro trader, so I don't hold, for example, right now, neither NASDAQ nor S&P 500. The good question here would come from a consideration. Does it mean I have to sell my S&P 500? Well, guys, this depends because if you are, for example, holding this ETF for 20 years and it's going to trigger long-term tax event and so on, I would probably not do that. If you're really like a long-term holder and you're like in your mid 40s or mid 50s, you can always borrow versus it and just keep those ETF into infinity. There is like one of the strategies as well. So unless you feel very comfortable trading S&P 500, maybe just don't do it, like, and keep it, because also I believe unless we really have a crazy black swan event, 10 years from now, it will be higher, just simply because we're living in a world of modern monetary theory and there will be always more fiat created out of thin air. So keep it as your collateral and then make the trades on top of that. There's a reason why I'm very comfortable to use, for example, Interactive Broker or Bybit, is because I can have my whole account allocated to thing I believe. For example, right now I want to be exposed to silver, palladium, and miners. And then on top of that, without wasting any of the collateral, I can actually make the trade. So I might enter China, exit China 1 month from now. I might buy SoFi, sell SoFi. So treat it as a comfortable collateral you would like to sit on, and then the things that you are buying for the next 24 months, right? So if you're speaking about next 24 months, I want to have not more than 15-20% of equities. And by equity, I obviously don't mean the silver miners, right? Silver miners still for us falls in the category of commodity in this case. And here I need to answer another question. What happens with a war escalation and stocks of silver producers still acting like stocks? Can it be the case? Yes, unfortunately, that can be the case because a lot of people are just gonna move through the panic selling mode. They're just gonna go and market sell everything they own. There is even a button on Interactive Brokers that is called close everything. I'm very sure a lot of people would just close everything, and there's a lot of, unfortunately, very, anxious on people around us. Anxiety is the most common emotion people experience. So a lot of people just gonna get triggered. They would see something on Bloomberg and they would sell everything. Yes, so this thing would go 10, 15, 20% down. But in the long run, for you need to rather focus on how do I spread my beats? How do I DCA so I actually catch those? And rather than how can I sell when others are selling? So we're all selling at 25% down, right? So reverse your mindset a bit because metals are going to go up and miners are going to catch up with them. I am not saying that this catch up will take 2 hours. This catch up also can take 2 weeks or 4 weeks, but the catch up eventually happens all the time. So thank you for everything you do. You're very welcome. How do you trade directly on TSX? Do you have to be a resident there? No, guys. You can trade anywhere. You just find the ticker that is representing TSX. So, for example, if you want to trade, I don't know which example to take, Cottony Silver. So you either gonna buy it as KTN, 3 letters on TSX on Toronto Stock Exchange, but you also have a ticker on the US exchange, and just Google and you will see that you probably have an access to both. You have an access to both wherever you are. So yes, I prepared a few alerts that I put some time delay. Thank you. Yeah, I'm a machine, guys. I'm working 14 hours a day and I love it. Very basic question here. Why is better to go with miners over using low leverage on the base value of the commodity to achieve same results? Oh, wow, that's a very good question. And let me answer that. And I think that will be it for today. It's super, super smart and a very good question. So let's look on the charts. Let's see, because this is also important. So there are multiple ways how you can use leverage. You can use leverage via leveraged ETFs, 2x ETFs, 3x ETFs. The problem of these ETFs is the backwardation. You remember Nick was giving you Boyle ETF. I don't remember when exactly, but I saw it in the newsletter. And you see what happens with those ETFs. You just look on the chart, and that looks very sad, especially if you go on a weekly and you see, oh my God, natural gas went down and the ETF went down. So now people think, oh, now natural gas is going to go up from $2 to $10. And now my boil is going to go from 44 to 14,000. No, it's not going to happen. Never. And mostly you're going to lose all your money while sitting in this ETF for long enough. And this is the case for all the leverage, majority of leveraged ETFs that are not backed by the physical underlying collateral. So you can take anything. You can take leveraged ETFs on S&P 500. You can take leveraged ETFs on Russell 2000. You can take also leveraged ETF on any commodity. So you need to understand if we are playing leverage on silver or on gold and you're entering the ETF like NUGT, let's look at the chart quickly. So it's the ETF you have to hold for, I would say, 2-3 days, maximum like a week if you are really in a parabolic move. Why? Because it's pegged to the future contracts, and the future contracts, they have such a feature which is called contango backwardation, based on the gap in the prices. And so in order to rebalance the value of this ETF, there will always someone being eating the piece from it. Just I try to explain it simply, but you got the point. We wanted to see direction daily gold miner index bull ETF, right? So this is another example of an ETF you should not hold for 2025, 2026, for example. Because once again, gold has been an uptrend, but the ETF is on a downtrend. So you would say, damn, what the fuck? But by the time you would discover why, your whole underlying asset, your whole position would be obliterated. And guys, we're like thousands of percents down. So you do those things for a day. Now, the second option, what you can do options. You can do options, and this is quite healthy actually, if you know what you're doing. And for this reason, for example, if you want to get exposed to silver, you either can get SLV options, 3 letters, or you can get exposed to SIL, which is silver miner options, for example. But you need to understand that options are very volatile. So you're going to lose. Now I'm going to daily. Now you're going to lose potentially up to 60 to 80% of the option value if you fully scale in now, if we are going into this ABC correction, and only then we are going up. So we're going to have our A, B, C, and then you have to decide what is the duration of your option, what is an expiration. I definitely recommend you to select 2026 January, because if we go in a wave C right now, then whatever you're gonna buy with an expiration of 2025, all gonna be obliterated with the theta or time decay. Here, if you use leverage and you're going into 2026, it's still going to look very ugly. You would lose 60, 70% of your nominal value, but then you can become in profit. But guys, I've been working with traders for so many years, and I've been a trader for many years myself. I know how your psychology would work. You would put there $10,000, then your $10,000 return into $2,000, you would suffer a lot. And then once your $2,000, even if it breaks back to $10,000, the first thing you would like to do is to sell and forget about that nightmare. So you're actually not going to end up making a lot of money. You're going to stress out, and you would like to exit your position probably as soon as possible. So you're either going to lose money or you're going to exit at break even with all the stress that you're going to inherit, through this 1 year of checking the price every day. So why I'm recommending the miners, because the miners having the leverage, but there is no risk for anyone to liquidate this leverage. There is no time decay, and there is also an opportunity to withstand any type of moves, even if it's taking you an extra year. Guys, I started acquiring silver miners, some of them in 2021 and 22. And so for sure, the entire 2022 was not a good time for me, but I knew my long-term plan. I was building my position, and that's why you've seen some of my positions there, like a 6-digit large positions right now, because I was able to withstand that decline and add more. If you go full in on leverage, that's unfortunately what happens with our friend Crypto Kaleo. Then the market is up, but the guy lost $500,000 because he was way too greedy and he couldn't maintain also the sanity through that period. So to sum up here, don't let the 13-year cup and handle go against you, because we are in a truly great moment. I think we are very, very lucky to have an access to that, but don't let this opportunity be wasted because you over leveraged yourself, right? So be smart about that. Guys, with all that said, I wish you an amazing continuation of the week. We're just on Tuesday. I really love this session. Thank you so much for all the support. Thank you so much also for the kind words and for the words of appreciation. Yesterday, I wrote every message, and a lot of you really resonated with my story. So thank you again from just the human side of me. It was really important for me. And I'm gonna copy, guys, our admins, can you please copy the messages from the chat today so we know that nothing is lost? And then on the next webinar, I'm gonna come back to them because I believe those questions are actually really good. Like out of like 7 questions I picked up today, I think most of them are really, really good and useful. Thank you so much, guys. And I'll share the link with you on the YouTube so we all can learn, even if someone missed it. I think today was a lot of alpha. Much love, and I see you soon. Bye.